Hey everyone, it's Monday, September 19th. Today on the Final Bar, we'll talk about this market choppy for most of the day, accelerating to the upside, hitting, where is it? 3,900, almost to the penny yet again. We'll break down the market from three directions today. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny but smoky Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts, using the technical capabilities of our platform and the best practices of technical analysis to better understand what is happening around us. These are volatile times. Even though the VIX is not above 40, it's not above 30, sort of in the mid-20s still. However, it certainly feels like volatile times, and not necessarily volatile in terms of wild price swings, but in terms of uncertainty. Remember, a lot of people call the VIX the fear gauge. I would say a better moniker is the uncertainty gauge, and we have plenty of uncertainty as we queue up the Fed meeting going through the remainder of this week, Tuesday and Wednesday. We have some great guests coming up, by the way, helping us prepare for the Fed meeting starting tomorrow. We have Samantha Leduc from Leduc Trading coming through the Final Bar tomorrow. On Wednesday, the 21st, Sam Stovall, who's the chief strategist at CFRA Research in New York. The two of those should help us try to prepare for what's coming and help us make sense of the announcements after the fact. The week after, by the way, we have Mark Chaikin, Miss Schneider coming through the show. It's going to be a lot of fun with some of these really, really good guests leading up to ChartCon. And that's the next thing I wanted to tell you about. ChartCon is our virtual event coming up October 7th and 8th. It is going to be an absolute blast. We've been preparing hard as a team. I have some calls set up with some of our presenters through this week and next week. We're actually going to be talking tomorrow morning about a bull-bear panel. One of my favorite exercises in a previous life of mine was having a bull-bear debate with some of my analysts. We would each take different sides of one particular chart and argue for that side, the bullish or bearish side. And it helps you just stretch your thinking, helps you think about different probabilities, different possibilities. And I found it was a great way to learn about market dynamics and prepare for what's coming next. That is one of the sessions that we will be having as part of ChartCon. You can sign up for that event at stockcharts.com/ChartCon members. And those on free trials for membership get a special reduced rate. So make sure you check it out. Let's continue on today's show with our market recap. Let's look at what's happening in the markets today. As I mentioned, pushing to the upside, the S&P once again hitting 3,900. Every time this happens, it once again reinforces the importance of that 3,900 level. Let's look at the charts and see what actually played out. As I mentioned, really moved to the upside in the last hour or two of trading, a sort of a sideways, unchanged day until the last hour where the S&P again pushing now up to 3,900 from below. That's up 0.7% from Friday's close. The Nasdaq about the same, a little bit more than that. Mid caps and small caps both up over 1% as well. The VIX down off a little bit below 26, but still sort of in that mid 20s. And we talk about how most of 2022, it's been between 20 on the lower end, sort of 30, 35 on the upper end. We're kind of exactly in the middle here. So talk about a wait and see period, sort of a sit on your hands period, waiting for the Fed meeting Tuesday into Wednesday. Wednesday's when we have Powell's press conference and most likely get a quick move or two as we often do around that trading day. Interest rates sort of chopping around with no real directional movement, although the 10-year yield did inch higher up towards 350. As a reminder, 325 was the peak in the fourth quarter of 2018. Reaching that peak earlier in 2022 was a significant signal. We then went above there. Now we're once again testing those all-time highs for interest rates. Now, I saw on social media, someone responded to one of my charts saying, interest rates are hitting key resistance, so they're probably going to go lower. That's possible. And when we look at the chart of the TLT here in a little bit, it's possible it's making a big double bottom. But I have learned never confuse the top of the page with resistance, never confuse the bottom of the page with support. Just because bond prices have gone down a lot doesn't mean they can't continue lower. And that's why I'd be eyeing that support level or the resistance level on the 10-year yield make sure you keep an eye on that. But remember that is not a hard and fast top, right? We can certainly go much, much higher than current rates are. And we have done that historically. If you look at the real long-term chart, gold and silver really unchanged from Friday's session, really sort of right where we were on the GLD and the SLV as well. Oil prices up a little bit, although energy stocks actually weaker today. Cryptocurrencies overall pretty negative going into the equity trading session here, but in the last 6 hours or so, most of those actually moving higher. Bitcoin is back above where it finished yesterday, currently around 19,500. Ether prices just below 1,400, around 1,360. Let's look at a chart of the S&P 500, and then we'll dig a little deeper into some of those charts that I teased, looking at interest rates and bond prices and elsewhere. So what do you have today? Sort of an interesting accumulation day, right? So Friday's candle, when you're looking at the S&P 500 cash index, $ SPX, bit of a hammer candle, right? Which is where you have the open and close near the top of the range, big, long, lower shadow, minimal upper shadow. It's called a hammer candle, usually suggests the next 1 to 3 bars are higher. So today, similar low. We actually tested Friday's low earlier in the day, but closed back above Friday's range, again, right back to that 3,900 level. And what I would tell you with support and resistance levels, with trend lines, I was taught once is chance, twice is coincidence, 3 times is a pattern. And even going further, every time you test the same level of support or resistance, every time you draw a trend line and you find that the price bumps up and or bumps down against that trend line, every time you reinforce that trend line or that support and resistance level, it just further validates the importance of that level. So 3,900, we first talked about that back in May, right? That's where we traded around. That's where we had a series of closes. That was actually the low close in May. That was that big rally into early June. That's the first time we actually talked about 3,900. From there, it's become important a number of times. We've traded up there from below, as we did in late June, early July. We've tested it from above, which is what happened in late August, early September. And now once again, after breaking down there on Friday on a closing basis, we're trading right up to that level. So, how bullish is the market with the S&P below 3,900? I would argue not so bullish, right? Being unable to hold a key support level like that is a pretty damning piece of evidence. That's a pretty negative data point. However, we regained 3,900, right? That once again is established as a floor. Then things start to get a little bit more constructive. Now, as we get a little later in today's show, talk about particular sectors, and especially when we get down to individual stocks, we'll try to hit on as many individual names as we can, but a chart like Home Depot comes to mind as having a clear support level. Microsoft, clear support level that we're still above, which means if those levels hold, the market's not too negative. We start to fail to hold those levels, I would be concerned about the overall market environment. Just to finish off, you're looking at a chart or two in the remaining in sort of this macro perspective. The chart of the TLT is an interesting one. You flip this over essentially, and you have the chart of $TNX, the 10-year yield. When you have something that's in an established downtrend, I think there are a couple things that I would do to try to make sense of these. Number one, where are we at relative to key moving averages? When I'm looking at the chart of the TLT, I see the price at the bottom, then a downward sloping 50-day moving average, and a downward sloping 200-day moving average. So that alone tells me this is in a well-established downward phases. Second, look at the momentum characteristics. Where are we at relative to where we may have been at previous parts in the cycle? You can see that on that last rally higher when the TLT hit 120, this was in late July, the RSI stalled out right at 60, which is, again, more characteristic of a bear market phase. Finally, when you're in an established downtrend, do you have any clear support levels? Now, we're testing and potentially breaking below that support from June. This is why we're at a key moment for the TLT. Flip that over again. This is why the $TNX, a 10-year yield, is at a key point. We're testing resistance around 350. Do we get above there? So that's where you look. Do we get a break below previous lows? Again, we're right at that point. I don't know if you can say it's necessarily been broken yet. I don't know if you can necessarily say this has been confirmed as a support level. I just say we're testing it right now. This week is going to be key. One important thing to note, we had a great bullish momentum divergence on bond prices May into June. We don't have that yet, right? We're still seeing the prices go lower, and we're seeing momentum go lower. By the way, if you don't look at our articles page, and just a moment before we get to my next segment, I want to point out Martin Ping. If you're a StockCharts member, Martin Ping just wrote a fantastic article over the weekend you should check out. This talks about the traditional relationship between bond prices, stock prices, and commodities. As you can tell from his title, he says the equity low is probably not going to hold. And a lot of that is because of the bond markets continuing to be in a trend with interest rates going higher. But read that article. It's a really well done talking about the relationship between those three major asset classes and why it's still potentially leaning bearish for stocks. Let's continue on our discussion with our next segment, which is sector setups. We talked about the big picture, talked about stock prices, rallying up to 3,900. But overall, I think the damage has been done with the break below 3,900 going into last weekend. Talk about bond prices continuing to push lower. Most likely not a great sign for stocks because lower bond prices means higher interest rates, tougher for growth stocks, and our benchmarks are dominated by growth stocks. However, let's look at the sector lesson, see what sector themes we can get. By the way, I had a great discussion with Julius de Kempener last week, really created this visualization a long time ago. And it's been such a pleasure over the course of many years, getting to know Julius and his work, working with him on this visualization and just having a lot of great conversations about offense versus defense and what it means. One of the things that he and I talked about is just this simple relationship, looking at the XLY, which is the consumer discretionary sector. Using the weekly data, you can see the XLY is arguably in the strongest position right now, right? In the leading quadrant, firmly in the leading quadrant, and heading in the right direction, kind of heading northeast or easterly, which is what it's doing. It's overall telling you stronger relative performance and the momentum remains strong. The other side of that, look at the XLP, which is down here. You can see that in the weakening quadrant and heading southwest, right, which is more the direction of deterioration. So between those two, the relative offense of the XLY versus the relative defense of the XLP, and you can see why this is overall a bit of a concerning setup, looking at offense versus defense. By the way, there's a lot to debate about whether we should be using cap-weighted ETFs or equal-weighted ETFs. I will draw you to two articles. My most recent article was this one right here, called "It's Not a Stock Market, It's a Market of Stocks." And one of the things we talk about is that offense versus defense ratio. My friend Tom Bowley wrote a really good article here, "Do You Believe in Equal Weighted ETFs?" where he talks about the different ways we can measure risk using those cap weighted versus equal weighted ETFs. I would check out both of those for sure. Really good thoughts from Tom, and hopefully my article adds some of that to some of that discussion as well. The overall thesis, though, is how bad can things be if offense is leading defense? And there are a couple ways we can do that. The chart I like to use to reflect that reality is in my Mindful Investor Live chart list, and it's, let's see, this one, consumer discretionary versus consumer staples. Now here I'm showing both the cap-weighted version in the top half and the equal-weighted version in the bottom half. A couple things to note. I would argue that the fact that the equal-weighted version of this ratio, and again, this is just simply looking at offense over defense, things you want over things you need, consumer discretionary versus consumer staples. When this ratio is going higher, it tends to imply a risk-on positioning by investors. When the ratio is going lower, more risk-off or more defensive. So in my opinion, in March of this year, when the cap-weighted version made a new high, but the equal-weighted version did not, that was a warning sign for me, telling me that the rally in March was probably to be faded as opposed to be bought, because there wasn't enough of a rotation into the defensive side, into the offensive side of the ledger. Investors were still relatively defensive there. You saw the same thing here in August, right? When the market rallied in August, the cap-weighted ratio breaking out, really driven by the strength in the names like Amazon and others like that, showing a lot of strength. However, the equal-weighted versions still have never gotten above their June highs. However, what's interesting about this ratio now is the market's sort of back, making a new swing low or at there, right? Sort of breaking below that 3,900 level, which tells me we're sort of in a risk-off environment. These ratios are still holding up pretty well, though. The cap-weighted ratio is nearing a new, 6-month high almost. The equal-weighted ratio, while not yet making a new high, is still not going down. And so you're certainly on a cap-weighted or an equal-weighted basis, you're seeing as the markets are selling off in the last couple of weeks, it's really more offense that's holding up much better than the defensive side of the ledger. It's actually telling you things aren't going to get that bad, I think, is what this ratio is telling you. What would this chart do to make me feel very risk off? This is going to get a lot worse, most likely. these would have to turn lower. Now, obviously, you have names like Tesla and Amazon that are holding up beautifully. Tesla, one of the better groups and one of the better stocks in one of the better groups, having a nice upswing through the course of recent history. So this ratio is holding up pretty well, but it's not just Tesla and it's not just Amazon, right? The average consumer discretionary stock is actually doing okay relative to consumer staples. And a lot of that could be just the weakness in consumer staples. However, the ratio arguably doesn't lie. It tells you that there's some interesting stuff to read there. Just to finish off this segment, I want to talk about utilities. Utilities is one of those interesting indicators to me because I like knowing what this relatively defensive sector is doing. Utilities are a lower beta, lower volatility, higher yielding sector. And although there are times in market history where a bull market phase is led by utilities, 2014 is one of the best examples of that, is one of the top sectors, if not at the top, at a time when the market overall was going higher. The relative strength on utilities has been consistently strong. And as a growth-oriented investor, you would never touch utilities unless you want to park things, park assets somewhere and ride it out and just wait to see what happens. The better utilities do, I would argue, the less encouraging that is about the overall market environment. The relative strength still holding up beautifully as the XLU pulls back to the 50-day moving average. Let's take a quick commercial break. We'll be back looking at shifting stocks. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we break down the activity in the markets using StockCharts. A couple quick announcements before we continue on today's show. First off, we welcome your questions. We're going to do a mailbag segment on Tuesday's show, also Friday at the end of the week. And those questions all come from viewers like you. Send us the things that you are struggling with as you're trying to navigate these markets. We'll do our best to point you in the right direction. Our email is the Final Bar at StockCharts.com. We are on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to answer one of your questions live on the air on Tuesday's show. Also, go to StockChartsTV.com. That is our on-demand platform. We had a really good episode of The Pitch last week. Greg Schnell, Tom Boley, Larry Tentarelli had a really good discussion about which charts were looking constructive. All three of them had Tesla as one of their 5 picks, which is the first time ever that happened. That episode is available on demand, along with a lot of great content every trading day. Go to StockChartsTV.com or on your mobile device, just search for StockCharts TV on demand. Let's continue on our show today with our third segment, Shifting Stocks. This completes our 3-pronged approach to market analysis and really is just a summary of the type of analysis that I like to do every week as a technical analyst. We start big picture, talk about the major macro themes. We look at individual sectors and rotations, and then we finish off looking at a lot of individual names and seeing what charts stand out to us. I want to start just looking at what I call the phenomena stocks. And this is a group of stocks that has changed its name many times, started out as the FANG stocks, and then I called those the FanMag when you added Microsoft and one other. And now I'm going with phenomena because you have Microsoft, Apple, Netflix, Amazon, Meta, Alphabet, NVIDIA, and Adobe. And those 2 tech names are important. Adobe, I think, just reinforces how much technology is driving these markets. A great example is sort of the software space. And then NVIDIA, top stock, arguably in a top group or a bellwether group that's certainly been struggling. And I think paying attention to all of these is arguably very important. But let's look at the group. And I just want to look at this chart here, because what this will do is show us the FANG index and then all 8 of these stocks in order. And you can just start to see as you look one by one, the reason why this market is in a challenging period is because I think these 8 stocks are all overall, I think if you summarize them, in a challenging phase. Now, the most constructive would be something like Apple. Nice rally, actually trading down toward Friday's lows. Didn't quite make it there, but bounced higher. That's after the hammer candle on Friday. It's like the S&P had a hammer. You had a hammer from Apple as well. So a nice, and I would argue, kind of an expected bounce today, given that bullish candle pattern going into the weekend. Nice rally today, and Apple doing better than the average stock, it would certainly appear. We'll come back to Netflix because this is arguably one of the better setups that you see. Amazon, though, you can see trading lower, maybe a bit of a bounce starting here. And you saw the bounce recently, but overall, I mean, since mid-August, in a clear downtrend. Look top to bottom, though, as you see Adobe making a new low, NVIDIA coming off of a new 12-month low. How many of these phenomena stocks are above their 200-day moving average? And the answer is 0. When you talk about when to be bullish, I would argue you need to see more than 0 of these 8 stocks getting above their 200-day moving average, right? And even when we rallied in August, how many of them actually made it above their 200-day? Only one. Apple was the only one of these 8 stocks that actually made it above its 200-day moving average as the market rallied in August. Amazon tested its 200-day but didn't get above there. Apple was the only one. It was obviously approaching its all-time highs there back in the 170s on an adjusted basis. The rest of these not making it above their 200-day moving average. So get bullish, get excited when those stocks are demonstrating their ability to regain key resistance levels. At this point, I'm certainly not seeing it. Now, when you look at Netflix, it's worth noting, I mean, talk about an outlier. While many of the phenomena stocks or the FANG stocks struggling, right, at or near lows, trying to regain previous resistance levels, but not quite doing it. Netflix arguably setting up the best, right? You had resistance around 200. We broke above there in July, now settling into a new support level around 220, we'll call it. 215. That's right about where the 50-day moving average was in early September. Now potentially rotating above there. Netflix gets above 250. I would argue that really completes that rotation from distribution phase to consolidation phase to now a new accumulation phase. Higher highs, higher lows. We're arguably still getting it. And I think we're arguably there. We're arguably getting that. Getting above 250, I think would be a nice trigger as one of the few stocks really able to regain previous resistance. I mentioned Tesla, and again, I feel like I've talked about Tesla plenty, so I don't want to beat a dead horse too much on that. But I would note, again, we're at or near sort of this new swing high, but we haven't quite made it above there yet. So around 315, that was the peak in August as the S&P sort of hit the 200-day and pulled back. Tesla was bouncing up around 315, hit it a couple times and pulled back. Now we're right back there again. How positive does that look if this name gets above 315, above the previous swing high after stalling out momentum-wise at 40 on the most recent pullback? That's a nice bullish rotation in a key stock in a key sector. Now, another key stock in that consumer discretionary sector would be Home Depot. A little different phase than you see with Tesla. Looks a little bit more like the market, arguably, right? Sort of topping out at the 200-day, pulling back. Home Depot has really been struggling over the last couple of weeks in the home improvement retailer space. But what's interesting to me is the fact that Home Depot's testing support, Microsoft testing long-term support, Home Depot's testing long-term support. So when we talk about what are your deep downside objectives for the S&P, and I would not be surprised to see the S&P hit 3,200 before this year is done. I think that's possible and certainly a reasonable downside expectation. But I tell you what I would need to see first before you hear me start vocalizing S&P 3,200 is a real possibility. And it's charts like these would have to fail at support, right? Microsoft is still holding its low from June. Home Depot is still holding its low from June. So how negative can things be when some of these stocks are still holding key support levels? Charts like this fail. Home Depot fails to hold 270, 265. Microsoft fails to hold its well-established support around 240. That's when I will start getting much more of a bearish with a deeper downside objective type of mentality to our discussions. At this point, I'm still seeing things that are in a transition, choppy kind of phase. I think Home Depot and Microsoft may be great examples of that. Now, one of the better charts out there, and we highlighted these as one of our 3 and 3, I think on Friday or Thursday of last week, Enphase Energy. And I wanted to highlight this when we're talking about shifting stocks, because as I was pointing out to some of my premium members over the weekend, one of the concerns I would have, top stock in a top group, 100%. If you look at the last 3 months, renewable energy equipment, certainly one of the better places to be. And look at the relative strength on Enphase consistently up and to the right. You have a warning sign here, though, of a bearish momentum divergence, higher highs in price, lower peaks in RSI. That's actually a topping signal. But I think, what do you do? So, that tells you the uptrend may be exhausted. The way you confirm that upside exhaustion is by breaking support, which means you need to get below 270, 275 to complete a negative rotation and validate that bearish momentum divergence. At this point, it's on my red flag list, but overall, I like things where the trend is going higher. That's certainly the case here. The other solar names doing just fine today, by the way. First Solar up 0.9%. Sunrun, which is a name we highlighted, flat for the day, but overall, just a nice rotation to more of a bullish phase. And I would argue, I think there's still a potential upside in some of those names. Two more to highlight for you here. And again, they're sort of in that bucket with Home Depot of testing support. Nike bouncing today up about 3%. So handily outperforming the S&P. Not a great chart yet. So what would cause this chart to be more of a great chart, right? How do you differentiate one rally day versus something more broad? So the story with Nike is a story of distribution for most of the last 8 to 10 months, making a new low into the low into July, right at $100 a share. That's a big round number, which is pretty key. So I would argue Nike fairly constructive as long as it holds 100. Are we establishing a higher low? That would be pretty encouraging. And I'd love to see it make a new swing high, get above 117, 118, get us above that August high, back above the 50-day. Then this could be a pretty compelling setup. At this point, still sort of in that consolidation phase. Could be a head and shoulders bottom, but we need to break above a trend line using those previous highs to really validate that thesis. That's it for shifting stocks. We don't have any more time to go through those. We do have enough time to go through the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. In our earlier segment, our market recap, talking about stocks versus bonds, we talked about the TLT. And again, I think if you're looking at one chart to make sense of the markets in 2022, it could be this one. I've talked about $TNX as being one of the most important ones because it's all about interest rates. It's all about what the Fed is doing to address inflation. And a lot of that Fed action ends up being illustrated beautifully with the chart of the 10-year yield, the chart of shape of the yield curve, the TLT, the ag, all of these sort of play on that same idea. Martin Pring's article, as a reminder, if you're a StockCharts member, you should check out that article. And if not, really good time to join as a member to check out his comments, because he is one of the best at thinking about the intermarket relationships, thinking about bonds versus stocks versus commodities. The general thesis is until you see an improvement in bond prices, that usually precedes any rally you'd see in the equity markets. And we're not seeing it yet. Bonds are at new lows essentially for 2022 over the last week or two. Look for an improvement here. Then you can start getting excited about a potential improvement in stocks. Overall, feeling a bit of a weight there in the fixed income markets tends to lead the equity markets. Second chart is looking at offense versus defense. I mentioned Tom Bowley's really well done article talking about cap weighted versus equal weighted ratios here. I think it's a really, really good read. I followed up with an article on Friday, which we sent out over the weekend, talking about this, among other things, I think, that tell the story of risk on versus risk off in this market. I'm skeptical about the long-term bullish thesis until the equal weighted version of this ratio makes a new swing high, and it hasn't quite done it yet. But I'm noticing as I'm looking at a bunch of charts over the weekend that even though stocks as a whole, the S&P, the NASDAQ pulling back over the last couple of weeks, these ratios are pretty much right where they were at the market peak in August. So it's telling you that offense is still actually hanging in there just fine. Finally, the chart of Home Depot, I think, is an example of many charts that are sort of testing lows. And if you think about one of the basic technical analysis premises of looking at risk versus reward, if you're looking at a chart of Home Depot and you would buy it today for whatever reason, let's say you bought it just before the close, what you are basically saying is I see upside potential reward to X dollars. Maybe it's $330, which was the peak from August. I'm not sure what your objective would be, but let's say you see some upside objective based on your technical analysis. And then what's the downside? And at this point, probably limited downside, right? If you assume that those June lows are going to hold, you're basically seeing a potential upside to 330 for a potential downside of about 10, 15 points. Not a bad setup. And that's why a lot of these charts that are testing lows like Microsoft and Home Depot and others, setting up with a potential meaningful risk reward. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the Final Bar. All of our previous episodes and some great interviews are at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.